Meanwhile, the East African Breweries Limited reported a 12% rise in its net profit to 12.2 billion shillings and 4% growth in revenue, which rose to 128.8 billion shillings. All of this despite a volatile operating environment across its regional markets. According to the brewer's full-year results for the period ending June 2025, there was a 6% decline in spirit consumption in Kenya, an issue that they've attributed to the growing infiltration of counterfeit and illicit alcohol in the market, now estimated at 60%. Jimmy Mbogo has more.
For the period ending June 30th, 2025, East Africa Brewery has faced numerous headwinds. But despite these headwinds, the group saw an increase in its volume by 2%, with beer volumes growing by 4%. Even as premium brands continue to post double-digit growth at 10%. However, spirit volume dipped by 6%, largely attributed to the impact of illicit brews on legal spirit sales, an issue that the brewer now says needs to be addressed urgently.
Where we've had a challenge is in mainstream spirits, whether it's Kenya Cane, Chrome, or Uganda Waraji. And the reason this category is challenged is to what I was talking about, mainstream having a lot more pressure from their consumer discretionary spend. So we have a challenge. We also are having a challenge in terms of recruiting. Remember, illicit. These guys, when they fall off the radar of our mainstream spirits, they go to illicit.
EABL further saw regional market growth across all three key countries, with Uganda posting an 8% rise in sales, accounting for 22% contribution to the group's total, while Tanzania grew by 20%, an equivalent of 15% contribution to the group. Kenya recorded the slowest growth at 4%, but maintained its dominance in the group's contribution at 63% of total business.
And I think what you may want to notice there is something I've always talked about, how we need to de-risk East Africa from being very Kenyan dependent. So you can see Kenya now is 63%, Tanzania is creeping up 15%, and Uganda is at 22%. So we expect this trend to continue.
The second question on expenses, touched on the 18% growth. We do have some one-offs there, largely related to tax. We are consistently in conversations with tax authorities and undergoing tax audits and examinations. And we've taken provisions, which if were not included in that number, the underlying expense growth is 4%, which is very much a manageable and controllable level. From a cost of sales perspective, that is largely inflation. We felt some inflation around grain and sugar. And I think you also saw some of the changes around us not being able to claim excise on glass. So some of those come into our cost levels and we have to absorb that as well. So that's what's hit the cost line.
The company has declared a final dividend of 8 shillings per share, even as they remain quote-unquote cautiously optimistic and committed to building their investment, which will focus on productivity, innovation and sustainability. Jimmy Mbogo, Citizen TV.